All right, guys, the CPI or Consumer Pricing Index data is in for July 13th, and it is higher than expected. So, we're going to talk about what that means for your real estate investments and what you need to do to be prepared. All right, so the Consumer Pricing Index numbers are in. Chris, tell us what the data says.
Yeah, so numbers came in at 9.1%. It was projected at 8.8%. So it came in higher than what was projected. And if you remember, it came in at 8.6% last month. So it was already projected to go up, but it went up a little bit more or even more than expected.
Okay, so what does this actually mean? Let's shift this over to interest rates. Obviously, the number one tool the Fed has to fight inflation is raising interest rates. So CPI essentially, if you just boil it down, is basically tracking inflation. And when it's higher than they want, they need to use their tool of interest rates to lower inflation. So how they do that is raising interest rates causes, ultimately over time, over enough time, it causes the cost of money to be so expensive that there's less money in the economy, essentially calming inflation down. So the Fed meets July 26th and 27th, and we are expecting, I believe, on the 27th, for the Fed to make a decision on what they're going to do with rates. Now, everyone kind of baked in that they were going to raise it 75 basis points. That's kind of the thought. Now, anything could happen, just to be clear. We don't know if they're going to raise them or lower them or keep them the same. But with this number coming in higher than expected, it's likely that they will do the 75 basis point or potentially even higher. So, Chris, if they do raise rates, what does that mean for people who are investing in syndications or current syndicators out there? What does that mean for them?
Yeah, so as they raise rates, I call it the last year or two, most loans have been on bridge loans, purchasing these properties, and those loans have variable rates. So as they raise the rate, the interest rate goes up. That means the payments go higher for those properties, which then increases expenses in those properties.
So just real quick, I want to jump in here.
Mm-hmm.
The reason they did bridge loans, these variable rate loans, is because it helped at the time, at least when rates were low, maximize the return for the investment, right? So that's why they did those loans. Now, what this means is if those syndicators were not conservative in their underwriting, and all the moon and the stars had to align for them to hit their business plan, but now rates are going up, and that's not aligning with their moon and stars. I mean, some of these people could be in trouble, right?
Yep. Yeah. And so putting in interest rates that are lower for the life of the deal, putting in, just exit valuation cost at continuing at the hot market that we were in for the life of the deal, call it 2 years, 3 years, 4 years, 5 years. If they're building that in, and obviously if things pull back a little bit, then they're obviously going to miss their targets or potentially be in trouble with the property.
So that takes us to Smart Wealth Equity. What do we do, knowing that rates are fluctuating and likely to go higher in the future? We want to talk about some of the things we do to make sure that you are protected. So the first thing I want to say before I'm gonna ask Chris, some of the things we do on underwriting, but the first thing I'm going to say is one of the things we know and we like about multifamily is in a rising interest rate market. Typically what's happening is side by side as the Fed's raising rates, that's causing, through the trickle down, it's causing 30-year fixed rates on mortgages to go up. Well, when you have housing at, let's just call it all-time highs, it's starting to come down a little bit, but not enough. You have housing at all-time highs, and now you have interest rates that are, double. There is a lot of people that cannot afford to buy a home today that could have 6-7 months ago. Well, we've seen it firsthand. Those people are now having to rent. And so that's putting more pressure on the affordable housing. And there's not enough affordable housing. This is what, especially in the areas that Chris and I are looking to purchase properties for Smart Wealth Equity. So there's already too little inventory. There's not enough contractors and labor to build the houses. The materials have been too expensive. Like everything's been kind of slowed down. So there's putting a lot of pressure on rental rates, especially these affordable rental opportunities, which is essentially what we look for at Smart Wealth Equity. So knowing that that's a possibility, that a very high likelihood that rates will continue, or rental rates will continue to rise. Now we don't build that into our underwriting, of course, but what do we do to protect our investors when we're going into underwriting a deal and potentially investing in it?
Yeah, so first I'll say that, I think one of our important factors is that both of us are pretty tied in daily to what's happening with the market. We're in different groups. We're talking with different, other experts in certain areas as well. We're making sure that we're keeping in line with what's happening and kind of just always getting feedback and getting information that way. So what we do, and we take that information and we kind of adjust our underwriting off of our own experience and also off of other experienced operators, and we make our adjustments to make sure that we're being conservative. So a couple of things here is, obviously if the rates are going up, we'll look at, we'll start looking at fixed rate loans. What are those fixed rate, rates at? Build that in, probably bump it up a little bit just in case it were to go up, prior to closing. So we definitely bump that up. We look at, to your point, we put in projected rents. We don't put in, extra growth in those rents, even though it likely could happen, but we just leave that in for safety at the lower rents. And so, yeah, so I guess the short answer there is like, we just make sure that we're adjusting our underwriting to be conservative, with the market and how things are shifting.
Sure.
We're definitely not trying to be aggressive. We're not trying to, exit cap is another one that's a pretty big modifier, but that means as that goes up, that means the value, if you will, of the property goes down. So we make that higher to predict a lower valuation at time of sale.
Like a worse economy, essentially, right? Like,
right.
Yeah.
Yeah.
So let me jump in here real quick. Basically, what we do is we stress test the deal. So we say, we know what today is, but let's just assume in the future it's going to be worse. And so we put that in our underwriting model. And that way, if a lot of things do go wrong, we are still in a position to where we can perform for our investors. And I guess just rounding out this deal, because we don't want this video to take forever, although we'd love to nerd out on this stuff all day with you. If you want to know more about Smart Wealth Equity and the deals that we look at and we underwrite that meet our specific special criteria, go to the description. There's a link in the description on signing up on our portal. You'll answer a couple quick questions. Someone from our team will get a hold of you, and we can make sure that you meet the criteria we need, and we can get you on our deal flow. So that's one way. Another way is we have an Ask Me Anything session that we do every single month. We'd love to spend 30 to 60 minutes with you answering questions you have on syndications or the economy or investing in general. We love this stuff. That's why we do it. And then, of course, if you want to schedule time with Chris or myself specifically, we have that option as well. So I'm Chase Craig with Smart Wealth Equity. This is Chris Miller with Smart Wealth Equity. Thank you guys so much for watching this. If you like these videos, subscribe to the YouTube channel because we're coming out with content like this every single week. So thank you guys for checking this out, and hopefully we'll be back and comment on what the Fed decides in a few weeks.